Aloha students, and welcome to the lecture on Chapter 1. In Chapter 1, we're going to be talking about basically the um, theory behind financial accounting and the environment around which it operates. A lot of general concepts and terminology in this chapter. Okay, so hold on, Okay, so the financial accounting environment. So financial accounting basically is providing financial information by profit-oriented companies, by nonprofit organizations, by any organization actually, providing that financial information mainly to external users. So people who are outside the company, those include people like investors, people who invest money in a company, buy the stock of a company, creditors, people who lend money to entities, their employees, so the employees of the company, labor unions, customers of the company, suppliers, of course, government agencies like IRS would be interested in the financial information of a company, etc. So these are outside of the company, they're external users. And that's what financial accounting is, providing financial information to people outside the company. As you remember from your principles of accounting classes, um, this financial information is provided mainly through financial statements. And you remember the different kinds of financial statements. We will get into those in quite a bit of detail later on in the course. So the balance sheet, income statement, statement of cash flows, statement of stockholders' equity are the main financial statements. We'll talk about this comprehensive income thing later on, so don't worry about it so much now. Okay, so if you look at companies, entities, there's different kinds of entities, and these are legal formations of companies, how companies are organized, in other words. So a sole proprietorship is a company that's owned by a single individual, hence the word sole. Yeah, so there's one owner of the company. A partnership is a company that's owned by two or more individuals. So it could be 2, it can be 10, it could be 30. So it's owned by 2 or more people or individuals. A corporation is owned by shareholders, people who buy stock in a corporation or in a company. Okay. We're primarily going to be looking at corporations in this textbook, but we will be applying it a little bit toward partnerships and sole proprietors as well. But again, the main focus of this textbook is on corporations. Okay. Investment credit decisions. So there's two ways for a company to get cash in. One is through shareholders. So company sells stock to people, shareholders, and in return, shareholders receive dividends. So dividends are a repaying of a company's profit to its shareholders. And we'll learn that later on. Or shareholders can receive cash through selling their stock. So one of the objectives of people buying stock is to buy it at one price and then sell it when the price is higher, thereby making a profit on selling the stock. Creditors, on the other hand, are people who lend money to a corporation, and they can get cash through interest. Interest is basically the amount you pay for the privilege of using someone else's money. Okay, and we'll talk more about that later. And the creditors, people who lend money, also get cash when they get paid back that money that they lent. That's called the principal amount. And that's a misspelling, should be PAL at the end. Okay, okay, a couple of different ways that we can do accounting, and those are called the cash basis of accounting and the accrual basis of accounting. Cash basis of accounting is you record revenues when cash is received. So cash comes in, that's when you record the revenue. Expenses are recognized and recorded when cash is paid out. Okay, so cash basis accounting is easy. You just keep track of the cash coming in and the cash going out. You don't have to worry about the timing. So as soon as cash comes in, you immediately recognize revenue. As soon as cash is paid, you recognize expenses. On the other hand, accrual basis of accounting is when revenue is recognized when it's earned. So regardless of whether you get the cash immediately or not, you record revenue when you've earned it, when you've done something to earn the revenue. So either selling a product or delivering a service. Okay. As soon as you completed that, you've earned it and you recognize the revenue, even if you're going to get paid later on. Expenses are recognized when they are incurred. So when it happens, okay, when something happens where you have to pay money to somebody else, whether you're going to pay now or you're going to pay later on, okay, you record the expense at that time when you have the obligation to pay someone else. Okay, and again, accrual basis of accounting, it's not based on when the cash comes in and when the cash goes out, but it is based on when you perform the services or when services are performed for you. That's when you record revenues and expenses. And we'll go over that when we do the homework, but here's an example. So Cargo Company has sales on account, $100,000 a year for 3 years. As you remember, sales on account means that they're selling their product or service, and their customer does not have to pay immediately, but they're going to pay you later on. Okay, that's what sales on account are. Okay, so they collected $50,000 the first year, $125,000 the second year, and $125,000 the third year. Notice that total adds up to $300,000, so $100 a year for 3 years. So that's when they actually made the sale every year of $100,000 each, but the cash was collected $50,000 the first year, $125,000 the second year, $125,000 the third year. The company prepaid $60,000 for 3 years rent in the first year. So they're paying $20,000 a year for rent, but they're paying it all at once in the beginning. Okay. Utilities are $10,000 a year, but the first year only $5,000 of cash was actually paid. Okay. And payments to employees are $50,000 a year. Looking at the cash flows, here's the cash that they collected. $50,000 the first year, $125,000 the second year, $125,000 the third year. Notice all the rent was paid out in year one. $50,000 of salaries were paid each year. And then the problem indicates that $5,000 was paid for utilities in year one, and then $15,000 the following year and $10,000 the third year. Okay, so well, don't worry about that. So under accrual, well, let me go back, sorry. Notice the cash sorry. Notice the cash. 65,000 went out the first year, 60,000 came in the second year, 65,000 came in the third year, for a total of $60,000 for the 3 years if you net them out. Okay, so cash basis, again, you keep track of your revenues when you get the cash. So this 50,000, 125, 125 is the revenue that they record. Again, related to when they get the cash in. The expenses are recorded as cash is paid out. So if you notice, the first year they paid a lot of cash because they prepaid the 60,000 rent. That's an expense for year one, okay, which is why you have a negative 65,000 cash flow. So in a cash basis accounting, it'd be a negative $65,000 profit because they paid so much of the rent up front. They made 60,000 in the second year, 65,000 in the third year. So notice the timing is kind of all over the place. On the other hand, accrual basis of accounting, you're recording the revenues when you earn it, and they earn 100,000 a year because they did something worth $100,000 each year to earn or be worthy of getting the revenue. Okay, so again, ignoring when they get the cash. And notice the expenses are recorded when stuff happens. Okay, the rent is 20,000 a year, so that's when they record it, 20,000 per year. Again, irrespective of when they get the cash. Salaries is the same as 50,000 a year, and utilities is 10,000 a year. So again, under the accrual basis of accounting, it doesn't matter when they pay the utilities, it's when the utilities happen, 10,000 a year. So the net income is $20,000 a year. So notice the total is the same as the cash basis. It's just the timing is different. The accrual basis of accounting is a better reflection of the true financial condition of a company. So all big companies use the accrual basis of accounting. Okay, and we'll see that when we do the homework on this chapter. Okay, so net income is a better indicator of future cash flows. The accrual basis is better than using the cash basis, in other words. Okay, on another topic, financial accounting and reporting standards. So the rules of accounting, basically. Those are called generally accepted accounting principles. In order to be able to compare different companies, they all have to keep track of their financial condition using the same rules. That's what generally accepted accounting principles are. Okay, so those are uniform, consistent rules so that that all companies use so that we can compare one company to another. Okay, because they use the same rules. Don't worry so much about this, but basically this is saying that the rules are set by the organization down here at the bottom. Yeah, now it's the Financial Accounting Standards Board is the current standard setting body. Okay, it's a private sector organization made up of accountants, basically. So they make the rules, okay, which then goes up to the SEC, Securities and Exchange Commission, which regulates publicly traded companies, and ultimately by Congress. Okay, so the rules are made by private accountants, and they're the basic structure is mandated by Congress to the SEC, who then leaves it to the private sector to come up with the rules that the SEC will be following with respect to accounting. Okay. So Financial Accounting Standards Board, just be aware that they're the ones who set the standards for U.S. accounting. Okay, again, that's called GAAP. No worries. The codification we will be using in this course, the codification is basically a document that consolidates all of the different accounting rules that were formerly located all over the place in different accounting pronouncements. Now it's in a central location called the codification, where all the official rules of accounting are. Okay, so prior to this codification, which was not that long ago, probably 10 years ago, to find the rules of accounting, you had to look all over the place. Now it's all in one place in this codification, and you'll get practice in using that codification in this course. Okay, the rules we just saw, generally accepted accounting principles, applies only to the US. In almost every other country in the world, there's a different set of rules. Those are called international accounting standards. Okay, and that's those are derived by the International Accounting Standards Board, which is similar to the FASB, only on a international scale rather than a US scale. So here's a chart, basically just showing you who makes the rules for US GAAP, FASB, and who makes the rules for IFRS, International Financial Reporting Standards. It's the International Accounting Standards Board. Okay, so there's two different organizations making the rules. One set for the US, another set for everybody else in the world. There's an effort, there has been an effort to try to consolidate, because with all of the international global business that's going on, it makes sense to have one uniform set of rules for the entire world. I mean, that just makes sense. But there's still two sets of rules, the US standards and the international standards. There's been some effort to consolidate those or to converge and bring those together. It's been ongoing for more than 10 years now. Okay. Unfortunately, it still hasn't been accomplished yet or implemented. So there is still two separate sets of rules. Okay, so don't worry about this so much. Okay, auditors. Many of you accounting majors might aspire to becoming auditors when you get out of school. Auditors are independent accountants that basically review financial statements and determine how reasonably stated those financial statements are. So it's an independent party, it's an outside eye looking at the financial statements just to give reassurance to readers of the financial statements that the financial statements are fairly presented. Okay, and we'll learn more about that when you take auditing class later in your careers here. Okay, let's see. Just a couple of conceptual things here. There's two ways of looking at accounting standards. One way is rules-based accounting standards, which means there's a clear-cut, definite set of rules that companies must follow in doing accounting. That's what US GAAP is. Okay. Those are rules-based, very strict, very narrow rules. On the other hand, objective-oriented approach, or more oftenly called principles-based standards, are there's no specific set of rules, but just a general objective that guide organizations on how they should do things. Okay. Example I always use is not too long ago, probably, when you were still living at home, there's two different approaches that parents take with respect to when you have to be home after a night of going out. Okay. Some parents set very specific curfew times. You gotta be home by 11 p.m. regardless. Okay, so that's a rules-based approach. A very specific um, time that you have to be home. The rule is you gotta be home by 11 p.m. Okay. On the other hand, a principles-based approach would be something like be home at a reasonable time. Okay, so there's no specific time. It just has to be a reasonable time. Okay, using the principles-based approach, parents who use that approach for curfews assume that their children are responsible enough to know what that means, a reasonable time. Okay, rules-based, on the other hand, is there's no leeway. You be home at 11 o'clock. If you're home at 11:01, you're late. You'll be punished. Okay. Principles based, on the other hand, is there's a lot of judgment involved. Okay. And it's a lot of judgment by in our example here, the kid. Okay. They have to determine what that means. And that's based on both parties knowing each other well enough where the parent trusts the judgment of the child. So that's the two different approaches to setting accounting standards. Again, the rules-based is US GAAP, principles-based is International Financial Reporting Standards. Again, which is the better approach? We'll talk about that in class. Okay, just like which is the better approach for curfews for teenagers. Again, there's benefits and downsides to both of those things. But the US is starting to move away from strict rules-based accounting standards and more toward principles-based accounting standards. But again, for principles-based standards, just like for curfews, the parent has to trust the child to make the right decision. Similar thing for accounting standards. By using a principles-based standard, the governing regulatory bodies are trusting companies to do the right thing and to have proper judgment. Okay. Ethics, you have or will learn all about ethics in your business ethics course here. So we won't get into that much detail right now, but throughout the course, we will be talking about ethical behavior by accounting professionals. Here's a good model for ethical decisions. Basically, ethics is doing the right thing, and these are the steps in trying to determine if you are doing the right thing. There's a new thing coming out called the FASB Conceptual Framework. It basically tries to set standards for how universities teach accounting to students. Well, that's one of the things. So it needs to be some kind of foundation or basic standard, common standards for all the different aspects of accounting. That's what the FASB is trying to come up with now. Don't worry so much about the details of this. We'll get to this in more detail when we talk about the homework. Okay, so accounting information. In order for accounting information to be useful, it's got to have these characteristics. And again, I'm not going to go through all of these in detail now, but just as an example, materiality. In order for information to be useful, it has to be important. It has to be of significance enough that it's going to matter to the decision. It can't be minor. Okay? So materiality again refers to how important a piece of information is. the decision to be useful, the data has to be error-free. If there's all kinds of errors in it, then that's not very useful data. Neutrality, meaning it can't be biased one way or another. Okay, if it's biased, then it's not useful information either because it's slanted toward one view or another. A couple others, timeliness. Okay. Information to make a decision is not very useful if it comes too late. It's got to be given in enough time to make it current, so the decision is based on current information. Consistency down here. Data has to be consistent in order to make the decision useful. Okay, if it's not consistent and it's inconsistent and not the same all the time, hard to base a decision on that kind of data. Okay, so again, we'll talk about these in more detail later on. One of the key constraints in making a decision, which we'll see throughout the course, is cost effectiveness. Okay. The benefits have to outweigh the costs of getting information to make a decision. Okay. If it costs you $10,000 to gather information to make a decision on whether to save $1,000 on something, that doesn't make sense. You don't want to spend more than the benefits of what you can get out of it. So again, the benefits have to outweigh the costs in order for a decision to be cost effective. Okay, otherwise, why bother if it's going to cost you more than you can save? The elements of financial statements, again, we'll go over this in more detail, but you should have covered this in your Accounting 201 classes. Okay, what's the definition of assets, liabilities, equity, etc., as well as revenues, expenses, gains, or losses. Okay, and again, I won't go through that in that much detail now. Okay, underlying assumptions are assumptions that we have to make in order to follow the accounting rules, I guess. And let me go through these in detail. Economic activity assumption says we keep things separate for separate entities. So all the economic events identified with a specific entity are gathered together in one place and put together as financial statements. So you have to separate different economic entities. So for example, if I run a business, I need to keep my personal economic events separate from my business's economic events in order to get a clear-cut picture of how the financial condition of my business and of me personally. Those have to be kept separate. So that's what the economic entity assumption is assuming, that things are different economic entities are kept track of separately. Going concern, a lot of what we do in accounting is based on the assumption that the business will continue indefinitely. So it'll last forever, in other words, okay? If you don't make that assumption and you say the business is going to close in a year, that really changes how we look at transactions. So we have to make the assumption that the business will last forever. That's the going concern assumption. The periodicity assumption says the life of the company is divided into time periods so that we can keep track of the financial information for the entity for each specific time period. The time periods are almost random in a sense, but the general cutoff or time periods that we divide up the life of a company into is generally annually, so every year, monthly sometimes, or quarterly a lot of times. we as people, we divide up our life into these arbitrary time periods called years. Okay, so we keep track of our life based on how old we are. So 25 years, for example. Okay, but nobody ever said that that's the only way to divide up your life. It just happens to be a standard that we use. Okay, we keep track of our life by years, but it could have been just as um, prevalent or just as likely that if a different type of calendar had been used, we might be keeping track of our life based on 10-month cycles, for example. Okay, so again, periodicity means we're dividing up our life of our company into consistent time periods, and again, generally years. Monetary unit basically says that our financial statements are measured using a specific monetary unit. So American companies use the US dollar as the monetary unit. Japanese companies use the yen as a monetary unit. So everything we do has to be measured in that unit. That gets into, which you'll see later in your careers in an advanced accounting class, what happens if a company does business in a foreign country and gets a different kind of currency. Well, everything has to be converted into that particular monetary unit. So for an American company, everything has to be translated into dollars. So that's the monetary unit assumption. Everything is measured in a single monetary unit. Okay, let's see. Don't worry so much about this. We'll talk about recognition and measurement concepts throughout the course as we're going through each of the specific topics. So don't worry about that now. Okay, so revenue recognition is an important area. When do we recognize revenue? Remember, in the cash basis, we said that we're going to recognize revenue when we get the cash. However, in the accrual basis of accounting, which is what the entire book is based on, we recognize revenues when we've earned it. What does that mean? Well, that means that the earning process is complete or virtually complete. So we did everything we need to do for the customer, and then reasonably certain as to collect the asset to be received, usually cash. So when we've done what we needed to do and we're pretty sure that we're going to collect the cash for doing what we did, then we can recognize the revenue. Okay, that's basically what this means. The matching principle is an important concept in accounting. Matching principle says that expenses incurred in generating revenue should be recorded in the same period. Okay, so if you spent money in order to make money, then the expenses, the spending of the money, and the related revenue, making of the money, have to be recorded in the same time period. So in the same year in most cases. Yeah. And we'll talk more about that in subsequent chapters. Don't worry so much about this fair value thing for now. And that basically is the main topics in chapter 1. Okay, and with that, that ends the lecture for chapter 1. So aloha.